Wonderful. So, hi, everyone. Thank you so much for joining us this Monday afternoon. We trust everybody had a great weekend and their Monday was off to a stellar start. Today, we have another very impressive turnout to learn about our new investment opportunity, which is a preferred equity investment in a neighborhood of New Jersey. It's Flemington, about 40 minutes away from New York City. Today, as always, we will be having our CEO, Joe Burko. He will dive into the opportunity in great detail. Please, as always, we encourage you guys to take this opportunity, ask Joe the questions, ask him to go into more detail using the Q&A option below. If you would like to speak verbally, please use the raise your hand option and we will call on you. So before I pass it over to Joe, let me please introduce the driving force behind our endeavor today, Asta Realty Capital. Asta, we are under the leadership of Joe Burko, and we have risen to the prominence as the current owner and participator of a phenomenal $2.2 billion real estate portfolio. Our portfolio spans across 12 major US markets, and we have redefined the industry standard with a consistent track record of delivering exceptional results. And we have produced an impressive 21% annual return to our investors to date, which is well above the industry average. So as I mentioned this afternoon, we're privileged to have our CEO and founder, Joe Burko. Joe will be diving into this exciting investment opportunity. Joe himself has over 25 years in the commercial real estate finance and investment banking industry. Just a few of Joe's achievements are founding Burko & Associates, which is our New York-based advisory sister firm. His industry accolades, such as the Power Broker designation by CoStar, and his tenure as an advisor to the New York State Real Estate Board from 2009 to 2018, appointed by 2 New York governors. So honored to have Joe with us here. As I said, guys, please use the opportunity to ask Joe questions using the Q&A or the raise your hand feature. And on that note, I will pass you over to Joe.
Wonderful. Thank you very much, Laura, for the introduction. Hello, everyone. Good to see you. We're going to be talking today about a short-term investment opportunity, investment in preferred equity. So what's preferred equity before we go into it? Preferred equity is essentially a tranche of equity that has a priority over what known as common equity. So what does it really mean? In event of payment, the first one that gets paid is obviously the bank. Second to that will be any preferred equity tranche. In this case, we're looking to raise $2.15 million for a project that we know, control, and own for the last couple of years with a local developer, a local New Jersey developer. The project has pivoted. We have an opportunity to add additional units to the project. We started with 100 units. Now we have 116 units. Another interesting component, we've had an office component, Regis, in the building. Regis has now left. It gives us an opportunity to add 7 more additional units. And so we're essentially using good news money. As the banks don't necessarily like to change and go back to committees during construction period, we essentially cannot go back to the bank. And our preference is to raise capital internally from our own investors. So what we're doing right now is, in fact, we're raising money in order to capitalize additional component of the project. Those components will increase the value of the project. While the cost goes up by a couple of $1 million, the value goes up substantially more. So we're going to be going into that. And Laura, if you can please share the presentation, we'll start. Okay, so as mentioned, Spice Lofts is located in Flemington, New Jersey. It's a 116-unit project. And it's a little bit of a mixed use. It's essentially an old loft building that we're taking, outfitting it from offices to, in fact, apartments, adding some additional apartments on top of the roof. And as I mentioned, on the ground floor, we've had the Regis offices, the shared office space company. Regis has left, been a shaky tenant from the very beginning. They left. And so we're going to utilize the ground floor in order to add 7 more apartments and utilize the additional space to put a nice gym in this area. Let's just make sure that we have, yeah, okay. Very great. So to the pictures here depicts how the existing project looks like today, right? So it's industrial, all industrial loft building, very charming, super high ceilings. Next to it, we're going to be building additional 76 apartments. And so it's a combination of existing space and space that will utilizing and outfitting for residential use. The project was acquired by us a couple of years ago. It's a total of 94,000 net sellable square feet. And essentially at this stage, we're removing the retail. We have a loan from Ocean Bank. Ocean Bank is happy with the project. Things are moving well on the existing property. It took us a little bit of time in order to get the approvals. We had to go back to the city a number of times in order to not just get the approval for the additional site that we're going to be building the new building on, but also make sure that the unit size are not confining. They initially wanted us to have very, very large units, so we created a nice mix. We believe the stabilization of this project will be around $21.7 million. We have about $4.9 million in this project today in equity, and the rest is debt. The terms that we have with our partners and with the local developers is that we'll bring the additional preferred equity position. Again, it will have priority to our current common equity. It will be up to $2,156,000, and we're going to do it in two tranches. Why we're doing it in two tranches? Essentially, the first amount of capital is going to utilize in order to build those additional apartments, capitalize the project. And if there is a need for another $956,000, the bank had told us that they're going to utilize some of the funds in order to inject into the project. Okay, but so it means basically, whenever a bank has a construction loan, it's compartmentalized. Certain amounts are allocated for certain things. As here, we're able to add additional apartments, more apartments than we've expected. The bank will take some time before they'll be able to utilize some of this capital and push it back to other locations so we can actually improve the property and add those additional units. It's a process. It takes time. Banks today are super finicky, and so we're not relying on them. But we are doing it in two tranches for that reason. The annual return, the structure itself is, we're looking at around a 1 year with 2 6 months extension. The annual return to investors is 18%. We're essentially making 15%. We're making 18%. We're keeping a little bit of the difference for our services. Why do we like the investment? It's a short-term investment. It represents an 8% current to investors, and at the exit, an additional 7% for a total of 15%. The project should take around a year. While we have a couple of extensions, the project should take about a year, and not more than a year, in order for us to get paid back on this amount. However, we're giving the project developer enough time to sort of, like, if he needs a little bit more time, he'll take it. We feel that it's a strong adjusted risk return. We obviously know the project, we know the progress, we know the opportunity here, the total amount of preferred equity, okay, between the amount of debt that we have in place and the amount of preferred equity that we have on top of it is no more than 65% LTC. So we're talking about very low amount as in terms of risk. The developer is a local developer, 15 years of experience. We've had another project with him before, which we were very happy. We made our money within the time frame that he mentioned. The location is showing a good amount of growth. New Jersey, it's kind of like a suburb, but it's good access to Manhattan and other office districts. And the construction is well on the way. The first building itself is very, very close to completion. We expect in the next 4 or 5 months, we should have at least the first building up and running. We'll have about 47 apartments over there, and I think we'll release them pretty quickly. We're talking about $50,000 as a minimum investment. Each project participant has a 3% participation fee. In this example here, we're showing an investment of $100,000 with $3,000 participation fee. We're doing the calculation based on 18 and 12 months, but keep in mind that there's 2 6-month extensions that if the project needs it, we'll be able to ask for those. The total gross return to investors is $18,450. So both due back to investors will be $118,450. So annual return is 15%. So this is basically kind of like how we're able to achieve the project 15%. If the project should be if the preferred should be paid earlier, we're looking at some rebate of our fees, and you have the calculations here. Anyone who's interested in this presentation, I'll send it over to you. Laura will send it over to you, including with this recording of this Zoom. You can go over it. But what we're doing, we're adjusting. So the question is, what happens in the amount if the duration of the return of equity will happen sooner than 12%? We'll adjust the fees accordingly. Okay, the fees that we're allocating, the investor participation fee, we'll adjust it accordingly. We'll rebate a small portion in order to make sure that you'll make no less than an annual 15% return, right? So that's essentially the idea. As always, the legal structure that we have a lot of control. While we always choose to have a local manager, a local developer that we work with, we have a lot of control. We keep decision rights. We keep major decisions. Nothing can be done without our approval. We also have a takeover provision. If we're not happy with our local partner and a local developer, we have the right to take over the project, oust him, and so on. What we're doing here is exactly the capital call protection. So when there is a need for capital call, like in this project, or like in any or most of the projects are happening throughout the United States, 90% of all projects are reporting time delays and cost overruns, because of significant increases to interest rate, and of course inflation. The cost things to get even more expensive. Every project is reporting some cost overruns. Over here, we're actually looking at a good news money, as I mentioned, but what we don't do is the dreaded capital call, right? So if a project is facing a situation where there's a couple of $1 million that's needed for the project, we don't cram down or we don't dilute our investors. It's something that we have in each and every one of our projects. What we do is allow for external capital to come in and create this tranche like we're doing now, which is a preferred equity tranche that has a priority. So before the equity gets paid, the preferred equity gets a priority of payment. But this way, we don't cramp down the investors. Nobody gets diluted. If an investor doesn't want to participate, he doesn't have to. The reporting, as I mentioned, is something that we offer all of our investors. We do a monthly follow-up, and in some cases, we do a weekly follow-up. We bring all this information out to you. We never sign on loans. It's something that we push along this obligation, not to our investors, not to ourselves, but we push it along our operating partners. And we always have alignment of interest. My money goes in, and our family money goes in, and take the exact same risk as everyone else in the deal. So the business plan, as I mentioned, we're talking about 2 different assets. One is existing, a gorgeous loft building that is being outfitted. Will have 43 units, and essentially, retail will be pushed around and will be changed into additional apartments. And then next door to it, it's a large site. Next door to it, we just got the plan approved for another 73 units in total. Okay. And so while this project is well underway, we just recently got the permits, and we got the units as we wanted them to be. And effectively, I think we have a very interesting site over there. We've taken a loan with 65% max dollars from a local bank. Construction, as I mentioned, is well underway, and we're getting very, very close to complete the first building. Some of the revision of the floor plan, I know it may not mean much, but this is where we're able to fit the additional 7 units, which obviously 7 more rental units, 7 more rental income. So we're very happy with this, and this is where the vast majority of capital goes to. This is the external of the building, the way it looks right now. As I mentioned, a typical loft building with high ceilings. You can see the additional parts that were placed on the roof. This is usually industrial buildings are built, very, very solid, and we were able to add an additional floor on top of it with a good amount of apartments. So it's quite unique, far advanced. The construction inside, the internal construction is far advanced. And we started in December of 2021. We acquired the property together with our capital partner, and the project is still going. We are at that stage right now, which is kind of sort of like, early 2024, well into sort of like a little bit over 2 years into this project. Our expectation is to exit in Q2 2025. A little bit about the capital stack or sources and uses, if you will. And so we have our senior loan, which is $8.9 million, our Astor Prefer, which was 2.15. This is the amount that we're raising now. We have in place $4.9 million into this project. Our GP partner has placed $1,651,000. Total sources, 17 million, 17 million point six. Okay, then you have the breakdown of, site purchase, boarded for 4.9 million, acquisition fee, all the good stuff, 17 million. This is sort of like how the uses of capital has been used. And on the right, you have the diagram. So it's pretty simple to follow. The first comes is the senior debt, and then we have preferred equity position, which will get paid prior to all the other equity.
Joe, just before you move on from the capital stack, would you mind, for one of our participants here today, would you mind just going on, spending a little bit more time on Astor's current position in the common equity and how Astor has structured this preferred equity investment as to not require capital calls, and how this is a very separate investment from our current position?
Okay, sure. So we've entered this investment. We were the 80% partner in the project with 4.9 million. Our partner puts required 20% or $1.6 million in the project itself. If you can go back to here we go. So essentially our position, where, as I mentioned, we're 75% of total project, and our partner puts 1.65. Our partner essentially has, his shares, we have ours. In our operating agreement, in the event that there is a capital call, and sometimes there's capital calls in projects, variety of reasons, we have a document. In our documents, it reads that capital calls are not the obligation of Astor and its partners. So we cannot come to us and obligate us to participate in the capital call. We drop it on our operating partner. Why? Because he's the one, or they are the ones that are running the day-to-day, okay? While we all focus on the budget, they're the ones with the plans, they are the ones putting together the budget, we approve the budget. If there's a change to it, then they can come to us, but we're not obligated to participate. So in this particular case, we've had, as I mentioned, good news money. We've had a large tenant leave, right? The Regis space, which was just a kind of like a co-working space that we're doing mediocre at best. And it was sort of like the ground floor of the loft building. We were able to find better utility for the ground floor by adding additional 7 apartments. Obviously, 7 more apartments cost money to create. Okay, that's a new part of the budget that we needed to add. And while we're doing this, we're also, it's what we call good news money. Why is it good news money? Because 7 more apartments, obviously, we're talking about additional income. And so altogether, the developer went out and spoke to different sources of capital to bring preferred equity. Preferred equity is the best method today to raise money for capitalizing projects. And so we have an agreement that if they have good terms, then we'll allow them to take the terms from the market. And if we wanted to participate, raise the money internally, then we'll have the right to do so. So that's what we did. At 18%, knowing that we can offer our investors 15% and create friendly terms, okay? Because we're still, it's still the same project. We're still part of the project. It's not adverse type of a lender. At these terms, I'm happy to give the investors 15%, and I'm happy to continue and investing in the project and capitalizing the project according to its needs. What we don't do is we don't cram down like a lot of other opportunities. You get crammed down. If you, as an investor, have a capital call and you don't participate in the capital call because you can't, because you don't want to, because of all sorts of reasons, then what happens is others who participate cram down your shares. So, for example, if you had 20% investment in this project and you choose not to participate in the capital call, you may find yourself with half the shares. Okay, so we don't do that. We create another layer, a preferred equity layer, that allows our investor to either participate in it or not participate in it. The impact to the bottom line will be that preferred position costs a certain amount of percentages and a certain amount of dollars. So maybe your returns will be a little bit lower. Not in this case, because I think the $2 million offsets the additional value that we have ultimately. But we're not looking into any sort of a cramp down. And this is the way we negotiate each and every one of our projects. I hope this answers the question.
Thank you so much, Joe. I'm sure that does. And to any investors who are emailing me and texting me whilst this Zoom is coming on, confirming I am receiving your commitments, thank you so much. I will circle back to you after the Zoom. Please continue, Joe.
Okay. Okay, so this is the our pro forma on residential rents. We're looking at around $2,200 per unit on average. A little bit of other income from other sources. We have an additional building on the site that has a retail in it, other than the one that I mentioned, other than the Regis. So we're looking at around 1.273 million in effective gross income. Operating expenses, we're looking at around 337, and stabilized NOI for both buildings combined 936. We're assuming a 5.75 exit cap rate. Valuations, essentially, we're looking at 16,288,000. We have an additional building that if we will to build it or sell it, it will go for another $5.5 million. So for a total of roughly, call it 21,763,000. Assume some selling costs. We're looking at around gross profit of around 3.464 million after paying back the bank and after paying back the preferred and everything else that goes along with it. Do I have the controller?
Yes, Joe, you do. Maybe do a little bit of a harder click, and I'm sure you'll be able to take it.
Mm-hmm. Okay. Let me go back to we have some rent comparables. As I mentioned, we've looked at a number of projects in the area. This is just a handful of those in order to evaluate the asset, in order to evaluate the rental in the market. The market is very strong. It's a growing community. And, our developing partner has done a number of projects over there and is really well vested in that particular community and the immediate towns around it. That's sort of like his backyard. We've looked at a number of projects that are kind of like brand new, and some of them that's been around sort of like the same circa 2020, 2021, just to sort of like, get the general idea of what sort of rent we should be expecting. I think we're going conservative. The rents have gone up, like in many places, the rents have gone up quite significantly. We're still going a little bit conservative, with our average, but we feel good with it. We feel pretty decent. We're also going very, very conservative with our exit cap rate. So I think that there's room for better news based on everything that's going on. Some of the projects that we've looked at and some of the projects that are in the area. All this information will be made available BSD Capital Management is our operating partners. Information about them, as I mentioned, good amount of years under their belt, about 15 plus years, various assets that they've built, various assets that they've exited, all successfully. So we're very happy to continue our participation. And for those who don't know, a little bit about Astor Realty Capital, like Laura mentioned, we're a company that's, I've been around for close to 30 years in this business, started in 1995, been in the advisory work for many, many years in New York City. I've done some large transactions and large projects, represented public companies, family offices, the state of New York for many years. And about, call it 8 years ago, I entirely pivoted and changed the way the company's direction went from the advisory and brokerage service into the investment side of the business. And then we've embarked on, and doing a national portfolio with that I have to say is doing pretty well, knock on wood, very successful. And we invest in various parts of the capital stack. So invest in debt structures, we invest in common equity positions, and then we invest in equity positions. Some of the key members here, as you can see, are here with us for many, many years. Some of them located right here in Florida. Some are still in New York. We have two offices, two major locations between Florida and New York. And that's in a nutshell. A little bit more of the pictures of buildings and the portfolio and the way that we're doing right now. I mean, as I mentioned, we're in 65 collective years of experience between the years for myself and other members of our team. Our portfolio spans over 12 U.S. major markets and participating in 2.27 billion total portfolio aggregate value. And at this point, we're about $100 million plus under management as of Q1. And that's the end of their presentation. So simple concept, investment goes in, we know the project, it's not new to us. You'll make 15% return on your investment over a course of 1 year. What's good about short-term investment is that, you put your money in, you put the money back, now you have more to hopefully invest with us or anywhere else that you wishes. And for us, it's a good opportunity instead of keeping the money and having it erode in the bank. Open to any questions and any comments.
Beautiful. Yes, Joe, we do have some questions. Sorry, let me bring the QR code as they come up. So the first question, Joe, is can you please go into a little bit more about our exit strategy?
Yes, so there's two exit strategies that we're considering. The first one is stabilizing building number one, building number two, and exiting sometime late 2025 with both building intact and finishing that. What we will do during the stabilization of building number one is we'll probably separate the first asset, which is complete and cash flowing, separate the first asset, release a portion of it, and at that point, either sell it or refinance it and repatriate some of the money. That will be one way to pay back the preferred. We want to keep the preferred for a short period of time. The other exit strategy is simply to ride all the way through and stay with the project for the duration of another year, a year and a half, 2 years maximum, and then sell both buildings, the new building with 73 apartments, the loft building with 43 apartments, and of course the other small retail piece that we have over there, and exit that way through the sale. Another conversation, which we're considering, another conversation is actually stabilize the first building and sell the building and the site with the approved plans and do it much, much sooner. So that will be much more, most likely exit within 9 to 12 months. That's essentially the three options that we have. So either stay for the duration, sell the asset, or refinance one portion of the building, repatriate some of the money, return back the money to the investors on the preferred, or simply stabilize the first asset and with the approved plan for the second site, essentially sell it and exit in such a way. Okay, and this is what we have, a duration that is between a year to all the way up to call it 2 years.
Beautiful. Thank you, Joe. And we do have a question, and I believe that I'll be the best person to answer this in relation to, is this investment going to be considered income or interest income? And to answer your question, Austin, we have not made a final decision as of right now what it will be classified as. So please watch this space. We will let you know ASAP when we determine what will be the best way for our investors as to what the form of income that we classify it in a tax related matter. We always do our best to make sure that whatever it is that how the investment's structured, we are always thinking of you guys at the end of the day, and we want to structure it best. So give us a couple more, another week or so, and I will report back in relation to how it will be structured in a tax situation. Joe, I have a few more questions. Joe, can you please share a little bit more about Asta's history and the rate of return that we've delivered in the past? Great question, Julie.
Sure. So our average today, is 21. I think I looked at it as of Q1. It's about 21%, give or take, a little bit over 21%. This is AAR, average annual return. Now, within it, you have different components. We have investments in debt structures, we have investment in equity, and we have investment in preferred equity. We have no losses, knock on wood, thank God, no losses. It's not easy years, not everything is a slam dunk. We probably have one or two from 26 different investments that the returns will be the single digits. But the overall portfolio is doing extremely well, with some of our projects are doing much, much better than expected. So we're very proud of it. It's a testament to our collective work. It's a testament to choosing good partners, great markets, and being conservative, thinking what could happen, what's the worst thing that can happen. We spend a lot of time on this. We go through 800 different transactions on an annual basis. We say no to about 98% of them. So 98 or 97% of the transactions that we see, we say no to, and we focus on just a handful of transactions. Why is that? Because we're very conservative in the way that we think. We understand the markets that we invest in. We do a lot of digging and a lot of due diligence. And so the probability of making a mistake gets shrunk significantly. So as I mentioned today, we have no losses. In fact, we've never had any loss of capital. And some of our transactions are doing better than expected. If you only focus on equity, the numbers will be much higher. Okay, and I think we need to kind of like explain that as well. Only focus on equity, but obviously when you invest in equity, you're taking an equity level risk, and so our typical returns tend to be higher than the 21%. But the average, the overall average, we're doing very good.
Wonderful. Thank you so much, Joe. And as of now, that is all of the questions that we have from our audience. I will, just to give everybody a final opportunity just to have a little bit of a think and see if there's anything more for Joe before we end. I will just let everybody know that there is this QR code here. I have also dropped it into the chat for any investors who are perhaps new investor who are not so familiar with our process. If you would like to submit a commitment, you can do so via the portal, or you can do so by emailing me directly. I'm confident that you all have my contact information, but if you don't, it is also in the chat. We are approximately right now, probably about a week away from having full legal documentation for your review. So at the moment, we are accepting commitments. You will receive this investment memorandum. We have full due diligence. So Asta strongly believes in full transparency with our investors. You receive all of the documents that our analysts spend hours and hours, weeks, months delving through. So you will have access to that as well. If, of course, you would like to have a one-on-one with Joe or any of our senior analysts to dive into it a little bit deeper, we're here for you every step of the way. But that is generally the general way to make a commitment to Asta Realty Capital. As Joe mentioned at the beginning of the webinar, We anticipate closing in about 3 weeks. Am I correct in saying that, Joe?
Probably less. I do want to mention that there's a very high amount of interest. It's a very small raise.
We
As
have
you all,
received a lot of interest already, so we are down to 5 units remaining.
so if there's interest, we take soft commitments. The concept of soft commitment, where investors, most of the investors have been with us for many, many years. Have been with us multiple projects for many, many years. People just shoot an email to Laura. People just shoot a text to Laura. Laura, put me down for 50,000. Put me down to 100,000. Put me down to 200,000, and we respect that. Basically, that's how it works. Once we reach our fill, and I suspect that it will happen in the next day or two, possibly even before, possibly even this evening, then we will close tranche one, and then you'll have the option to participate in tranche two should we need to raise money for tranche two. If there's interest and this is a good opportunity, give it a shot. Shoot a text to Laura. Shoot a text, an email to her. I expect this to be kind of like fully subscribed very, very shortly. Okay. Thank you all. I wish you all good luck. I hope to see you in this project, and there's more great things that are coming about. If this project is not for you for any reason, there's more great things that we're working on, exciting things that we'll spend more time on together. It will be in the next couple of months. But for now, I want to wish you all a great evening. Thank you, Laura, and thank you everybody else who participated.
Thank you all so much, everybody. We'll speak soon, and I'm here if you need anything.
You work hard for your money. It's time to let your money work just as hard for you.